The market right now is in turmoil, so retail investors are looking to indicators to see when they need to go back into stocks. And the one they always like to talk about is the price to earnings ratio, or the PTE ratio. And this has been a fundamental metric in investing, for about 100 years. But it's really a flawed metric and shouldn't be used on its own to make an investment decision. And I'll give one reason why. Investing, if you want to boil it down to the basic metrics, there's really three that if you combine, you can get a good intrinsic value of the company. One is the price to earnings ratio. The second is the book value of the company. And the third is the earnings growth. Now, that sounds simple, just three metrics, but the reality is the earnings growth is the hardest part of all of this to actually make an assessment, especially with growth stocks like technology stocks, penny stocks for sure, or any kind of growth is harder to assess. But if you go into the right sector, earnings growth really doesn't become as big of an issue to assess. So then all you have is the price to earnings ratio and the book value per share. So why is the book value per share important? Some companies already have a bunch of assets in their portfolio when you buy them. The most egregious example was Apple. There was a point in time where they had so much cash that the cash was like $11 per share. It just was that crazy. You're buying $11 of cash per share when you bought Apple. Another extreme example was when oil prices were crashing years ago. Chevron was so cheap that its price matched its book value per share. That was the market indicating that it didn't even think Chevron could make any more earnings forever, that the oil prices would never come back, and that you could just buy its equipment wholesale and its cash wholesale because it never has any more earnings potential. That's just crazy. However, if you only look at the PTE ratio, you don't even see all these assets. You don't even understand where they're at. You could go to other extreme example with Boeing. So Boeing, regardless of the price to earnings ratio it had years ago, its assets were negative. It had negative assets because of all the debt it accrued, but you had to reassess the price to earnings ratio differently because you were buying into a debt-ridden company. So you really wanted a lower price to earnings ratio to make it worthwhile to buy the company, barring any growth or anything like that. Really, when you look at the price to earnings ratio, you gotta also assess the cash, the book value per share, all this assets that the company has, because it can really alter where you want the price to earnings ratio to be for a certain company. I think the final note I would make is that the reason why we gave price to earnings ratio suggestions for different sectors is because in general, their growth potential and the amount of assets per share they would have are going to be different per sector. So a bank will have more assets per share, so they won't need as much of a price to earnings ratio, while a tech company will have a lot of growth but no assets, so they would have a higher price to earnings ratio. So you really can't use a price to earnings ratio generically across the stock market. You really need to look at these other things. And if I can only give you one more thing to look at as a new investor, look at the book value per share of the company, because that's a really good baseline to start saying, hey, this company is trading at $20 per share, but $5 per share is already covered by its assets. And so all you have to really assess is that remaining $15 per share to understand if their earnings justify that price. Well, thanks for listening. Please feel free to subscribe and then check out stockbossup.com, where you can find all the different voices from the internet giving their stock ideas and us only trending the best performing ones. Thanks for watching.